Uh, Hello everyone, and welcome to today's class. Today's class, we will be looking at the accounts of non-profit making organizations. Previously, we've looked at accounts of partnerships. We also looked at accounts of those organizations that issue shares, we call companies. And we focused on the issue of shares. And this class will be a continuation of the of what we are supposed to cover in our course outline. So let us look at the accounts of non-profit making organizations. So in earlier classes, we must have looked at the accounts of profit making organizations, that is those that are formed with the motive of making profits. However, we have those other organizations that are formed for the purposes of serving the interest of the members. Therefore, their main objective is not to make profits. So we will be able to look at how do you prepare accounts of those organizations that are supposed to serve the interest of the members. So there are a number of areas that we will be covering. Those areas include looking at the nature of these organizations, that is the nature of the non-profit making organizations, getting to know why are they in existence, and probably look at the various examples of these organizations. Number two, we will be looking at the differences between the non-profit making organizations and the profit making organizations, and especially the kind of accounts that they prepare. So we look at the differences between these two in terms of the financial statements that each prepare, and at the same time, we look at the various items that appear in those financial statements. Number three, we will look at the statements themselves. That is the statements the non-profit making organizations prepare. And of course, we will be able to look at how are they different from the financial statements that are made by the profit-making organizations. We will then look at the various items that we find in the statements of non-profit making organizations and explain each of those items. You will realize that some of the items that we find there may have more than one way of being treated. So there are sometimes items that we find in these statements that can be both an item of the balance sheet or can be an item of income. So it will depend on the purpose of that item that will then explain to us whether it is a balance sheet item or an income statement item. Then we'll of course be able to look at illustrations to show how can we then prepare these financial statements. So we look at examples and their solutions on how one can prepare the non-profit making organizations statements. So let us look at the first item, looking at the nature of these organizations. You will find that these organizations are normally called sometimes welfare organizations. We call them the welfare organizations because they are, of course, established to promote or serve the interest of the members. Therefore, they are established to serve the welfare of the members. So their main objective then is not to make profit, but rather serve the welfare of the persons who form them. Uh, you will find that in some books, they call these organizations non-commercial organizations. So they are sometimes called non-commercial organizations in the sense that when we talk about commercial, We are talking about those entities whose main objective is to make profit. So for the non-profit making organizations, we call them then non-commercial organizations. So these organizations are not meant to make any profit, but rather serve the interest of the parties that form them, or at times they are supposed to serve the interest of the general public. Especially if you are talking about a charitable organization, then the main objective of such organization is to serve the interest of the public. So in essence, we have seen that the purpose why these organizations are established is either to serve the interest of those who establish them, like member clubs, or serve the interest of the general public, like charitable organizations. Let us look at the examples of these organizations. Number one, we have what we call charitable organizations. So these essentially are supposed to serve the interest of the public, not necessarily the members who establish them. So the charitable organizations, we have examples like the human rights groups, we have the animal rights groups, we have the hospitals, we have emergency relief services like the Red Cross and St. John's ambulance. We also have charitable schools and colleges. So charitable organizations is an example of those organizations that are supposed to serve the interest of the general public. Number two, we have the professional and trade associations. So these are organizations that are formed by various experts in various fields. Like for instance, we have the Chamber of Commerce, we have the Law Society of Kenya, which is an organization formed by the lawyers. We have the ICPAC, that is the Institute of Certified Public Accountants of Kenya. So these organizations are professional organizations, and their main purpose is to serve the interest of the professionals in their various fields. Number three, we have the religious organizations, and these ones include the mosques, the churches, etc. So those ones are also non-profit making organizations that serve the interest of the church members or the religious members. We also have welfare organizations, which again serve the interest of the members. We have organizations like the sports clubs, we have the social clubs, and etc. So those again are established to serve the interest of those members that form them. We also have scientific groups. In most cases, you will find that these organizations are either formed by the organization, by the countries, or other multinational organizations. So the scientific groups have the main aim of doing research. So their main aim is to do research, and of course, from the research findings, you will find that people will benefit. We have organizations like the general research groups, we have the cancer research groups, we have the chemistry research groups, and etc. And finally, we have what we call the educational institutions and libraries. Educational institutions and libraries, where we have organizations like the universities, the schools, the primary and public schools. We have entities like the Kenya National Library. So those ones fall under the category of the educational uh, institutions and libraries. So their main aim is then to serve the interest of the public. So those are some of the non-government, non-profit making organizations which are established, as we have said, to either serve the interest of the general public or the members that form them, or even both at some times. Then let us look at the differences between the two organizations. That is, what is the difference between a non-profit making organization with a profit making organizations? And we are looking at it from the point of view of first, the financial statements that they prepare, and number two, how do we treat certain items that are in those financial statements. So let us first look at the differences in terms of the accounts that they prepare. Number one, you realize that these two organizations will prepare different accounts. Therefore, you will find that instead of these organizations preparing a cash book, they will maintain what we call a receipts and payments account. So a cash book in this case is equivalent to a receipts and payments account in the books of a non-profit making organization. So a commercial entity or a profit-making entity will prepare a cash book, but a non-profit making organization will prepare a receipts and payments account in its equivalent. Number two, uh, a profit-making organization will prepare an income statement, but an equivalent of an income statement in the books of the non-profit making organizations, they will prepare an income and expenditure account. An income and expenditure account. So in this case, you'll find that an equivalent of an income statement where an entity determines whether it makes profits or losses, the non-profit making organizations will prepare an income and expenditure account. Now, up to that end, you will find that these organizations or the non-profit organizations are not formed by any one owner. So we normally say that they have no owners. Then the question will be, if they have no owners, how do they get their capital to form these organizations? You'll find that the capital that is used to form these organizations comes from the members' contributions. Sometimes they receive what we call donations. Sometimes they generate income from an investment that they have made. So, in essence, then, when you combine the members' contributions, the donations they receive, whether they are specific or general, or investments or income from their investments, they'll have what we call an accumulated fund. So they'll have an accumulated fund instead of capital. So whatever they contribute as their contributions, or whatever they receive as donations, those that will be capitalized, or whatever they get from the investments that they have made, will then be pooled together into what we call an accumulated fund. So in essence, we are saying they do not have capital. So in its place, they have an accumulated fund instead. So having said that, you will find that in those financial statements, like for instance, in the income and expenditure account, you will find that for a profit-making entity, it will determine a profit or a loss. So it will either have a profit or a loss. So if in a non-profit making organization, their incomes are more than expenditures for a particular period, then the excess should be a surplus. So the excess of the income and expenses or expenditure, we have a surplus. But if it was to be in a profit-making organization, then we will have a net profit. So instead of a net profit, a non-profit organization in its income and expenditure account, it will declare a surplus. And if the expenditure is more than the incomes, then the difference becomes a deficit and not a net loss. So it will be a net loss if it is a profit-making organization, but if it is a non-profit making organization, then the difference between the two is a deficit instead of a net loss. So, however, despite the differences in the accounting and the financial statements, the preparation of those financial statements is based on the same principles, the same accounting principles. So when you are preparing the financial statements, you adopt the same generally accepted accounting principles in the preparation of the statements. So despite the differences between the two financial, the two sets of the financial statements, the principles that are applied in their preparation are the same. In other words, if you are applying the accrual basis of accounting, then for both the income, for both the profit making and the non-profit making organizations, you apply the same principle. If you decide to use the money measurement principle, then it is for both. If you apply the materiality principle, the going concern principle, all those principles are applied the same. But you will find that when it comes to the capital, of these organizations, you will find that a non-profit making organization has an accumulated fund, as we have explained, instead of capital. So sometimes you'll find that given the nature of these organizations, we have various items of revenues and various items of expenses that may require some special treatment. So given the nature of these organizations that they are not profit making, then some items may require some special treatment. So we are saying despite the application of the same accounting principles, there are certain items that may require to be treated in a particular way because of the fact that these are non-profit making organizations. So we will then be able to look at all those items and check how different do we treat them from the normal profit-making organizations. Before we look at the specific items and how they are specially treated in the statements, let us look at the statements themselves and see the differences between these statements and those of profit-making organizations. So the first one is to look at the receipts and payments account. The receipts and payments account, we said this is an equivalent of the cash book in a profit-making organizations. The same way we prepare the cash book on the basis of cash, it is the same way we also prepare the receipts and payments. That is what you record in the receipts and payments account is on a cash basis. So whether you receive cash or checks, or whether you pay cash or checks, that is what qualifies these entries to be made in a receipts and payments account. That means then you will record the receipts on the debit side of the receipts and payments account, and you will record payments on the credit side of the receipts and payments account. Uh, this account does not distinguish between revenue items and capital items. So irrespective of whether the cash is received or paid on a revenue item or a capital item, you will still record them. So the only thing you look at is whether there has been either receipt of cash or a payment of cash. So there is no distinction between receipts of capital items or receipts of revenue items. So we are saying, therefore, that capital as well as revenue items are recorded in the receipts and payments account. Then we are also told that no provisions are recorded in this account. No provisions are recorded in this account. In other words, we only record cash transactions, and cash transactions involve receipts of cash and payments of cash. And of course, we said we do not distinguish whether they are capital receipts or capital payments, or revenue receipts or revenue payments. And we also say that this account has an opening and closing balance, which should be reflected as current assets in the balance sheet. So at the end of the day, you will have the balances in this account and that balance. And since we have said we only record cash transactions, it will always have a debit balance. And if it is going to have a debit balance, then we are going to treat it as a current asset. So that is the receipts and payments account. Let us look at the income and expenditure account. As we said, that the principles that we use for preparing the income statement of a profit-making organization are the same principles that we are going to use in preparing the income and expenditure account. That is why we are saying that this is similar to the income statement and it is prepared on the same accounting principles. And that is the same accrual principle. And we are saying that in this case, then, there is now a demarcation between capital and revenue items. So in this account, we only record revenue items. So only revenue items are recorded in this account, that both the incomes and expenses are recorded on the basis of accrual. That is, when incomes are earned and when expenses are incurred. So the incomes that we record in the income and expenditure account are recognized in it when they are earned, and the expenses we charge in this account are recognized on the basis of when they are incurred. And of course, we say incomes are incurred when the transactions for the revenues have taken place. And we also say expenses are incurred when the benefit from the expenses are enjoyed. And we are saying then, apart from adopting the accrual principle of accounting, we also must match them. That is, the matching principle should also apply in the sense that we must only reflect the items that happen during the current financial year. So any item that does not belong to the current financial year will, of course, be excluded from these items. So we are therefore saying that previous and subsequent year items are excluded because we are using the accrual basis of accounting, which should be matched with the matching principle, whereby only the items of the current accounting year should only appear. Then we are saying then at the end of the day, this account should either tell us whether we have a surplus or a deficit. It will be a surplus if the incomes are more than the expenses, and a deficit if the expenses are more than the incomes. So that income and expenditure account, as we said, it must be prepared on the basis of the accrual principle of accounting. So the format of the income and expenditure account is, as you can see from the screen. Uh, it is a very simple statement whereby first we get to know the incomes, we accumulate the incomes, and we have a number of items that form incomes. So we have the income from trading activities. So if an entity has some part of it that trades, then the income from that activity should be recognized. For instance, if an organization is operating a side business which makes some profit, then we should take the profit from that entity into this format or this account. For instance, you may find that a non-profit organization may establish a business so that they use that business to generate some income. So if a non-profit making organization has opened a business entity, then any income from the business entity will form part of the incomes of that organization. So in the income and expenditure account, we will have any profit that is generated from an income generating activity. Take, for instance, Red Cross. Red Cross has a business entity in the hospitality industry. It has opened hotels like Boma Inn Hotel. So Boma Inn Hotel is a business established by a non-profit making organization called Red Cross. So any profit that you get from Boma Inn will be put under this item, the profit from trading activities. An organization, an educational institution like Mo University has opened or has owned a business organization called Rivertex. So any profit that they generate from the Rivertex will be part of this item, that is the profit from trading activities. So it is possible that a non-profit making organization may have as a subsidiary a business segment. So that business segment will generate some profit. So any profit from such will be put under the profit from trading activities. The second item under the incomes will be subscriptions. Subscriptions, these are the monies paid by the members or the persons who have agreed to form that association. So these subscriptions can sometimes be made monthly or even yearly. So any of such subscriptions will be part of the income of the non-profit making organization. Number three, you'll find that these organizations sometimes may have made investments. They may have invested in shares, they may have invested in bonds and etc. So any income that they generate from those investments, or they could have started a certain project. So any income from such investments will be part of their incomes. And we also are talking about donations. So there are some donations which are general in nature. In other words, any donation that is not received for a specific purpose, any donation that is not received for a specific purpose, then it will be treated as income of that organization. However, donations which are made for specific purposes should not be treated as incomes because they are meant to serve specific purposes, and therefore it will not be income to the organization. So the donations that will be form part of the income of the non-profit making organization are those that are general. They are received with no conditions attached. And then, of course, lastly, we have income from other activities. So any other income apart from the above. So any other income apart from the above will be part of the incomes. And for example, we could have a festival, and during the festival, the entity may receive some entrance fees, some dinner dances, and etc. So all those are incomes for the non-profit making organization. And then we have the expenditures. So we have the expenditures. There could be as many as possible. We could have depreciation, salaries, expenses on other activities, and loss from trading activities. So if it is profit, then it becomes income. And if it's a loss, then it becomes an expenditure, and any other expenditure that may be incurred by such organizations. So when you take the difference between the incomes and the expenditures, the difference should either be a deficit or a surplus. So you should either have a deficit or a surplus. So that is the format of an income and expenditure account. Uh, these items that appear here, we will look at them in specific in a short while. So let us then look at the other uh, financial statement, and that is the balance sheet. So for the profit-making organizations, we know how the balance sheet looks like, which is not very much different from the balance sheet of non-profit making organizations, except a few items, and the items that are different from the other balance sheet will be on the funds, on other funds, and the accumulated fund, But the balance sheet is just like the that of profit-making organizations, at least for the first three segments. So the first segment is where you present non-current assets, and of course, you know, non-current assets, you present them at their cost, their accumulated depreciation, and then the net book value. Then you present current assets. Of course, we have the stocks if the company or if the business is as a trading segment and etc. So we have the current assets. Then you present the current liabilities. So the current liabilities will be deducted from the current assets so that you can determine whether you have a net current asset or a net current liability. Then you will then have what we call net assets. So the net assets are therefore financed by, now this is where we get the difference. So the net assets of the non-profit entity are financed by, now instead of capital, we have the accumulated fund. And we said the accumulated fund could arise from contributions by the members, the donations they receive, or the income from investments. So it is gotten from the accumulated, the net assets are financed by the accumulated fund, which is brought forward from the previous year, and then it will be increased by a surplus or reduced by a deficit. And then, of course, the financing of these net assets can also be by way of other funds, like we can have a life membership fund. Sometimes those who become life members of the non-profit making organizations will have contributed monies for the life membership. So that life membership contributions are put in a particular fund. You could also have a building fund. This is the monies put aside for the purposes of building. And we could also have an education fund. Sometimes monies could be put in a particular fund for the purposes of education. So any money that is earned by these funds, any income that is earned by these funds, it will be added to them. Like, for instance, if you receive funds that are meant for education, or if you receive donations meant for education, it will be put in the education fund. So if you have built a building and the purpose and the building is from a building fund, then any income like rent received from the building will be credited to this fund. So the total of the funds and the net of the accumulated fund should be the same as the net assets. So the difference then we have in this statement, that is in the balance sheet, is on the financing part. So on the financing part, the net assets are financed by the accumulated fund and other funds of the entity. So let us look at a few of those items that we find in the items of the non-profit making organizations and how can we treat them in those statements. The first one is the subscriptions. So normally we are saying that these subscriptions are monies that are received from the members who either are renewing their membership or are paying for new membership. So any money received from the members for renewal of their membership, or they are making it for the first time, then it is treated as income. And if it is treated as income, then we find it as a revenue item in the income and expenditure account. So this is an item of income and expenditure account. Now, sometimes you'll find that we have members who may not have paid subscription for a particular year. So any of such subscriptions that have not been paid for a particular year, and of course they are supposed to be received. So we are saying any subscriptions that are not paid but they are due for payment, they are called debtors for subscriptions. Debtors for subscriptions. So any unpaid subscriptions, we call them debtors for subscriptions, and they are recognized in the balance sheet as assets. So we will have debtors for subscriptions being current assets in the balance sheet. So debtors for subscriptions are those subscriptions that are due but not yet paid. So the organization is supposed to have received them, but it hasn't received them. Therefore, you treat them as debtors for subscriptions, and they will be treated as current assets in the balance sheet. But remember, for subscriptions, we treat them on the basis of accrual, on the basis of accrual, unless otherwise told. So we look at the subscriptions that are supposed to be received for that particular year. And then, of course, if you have subscriptions which have been received in advance, any subscriptions that have been received in advance, then we call them creditors for subscriptions, and they will be treated as current liabilities in the balance sheet. So we treat these as current liabilities in the balance sheet. But remember, any subscriptions received in advance will not form part of the income in the name of subscriptions for that particular year, because the basis we are preparing these financial statements is the accrual basis. So any subscriptions received in advance, we call them the creditors for subscriptions, and this item is treated as a current liability in the balance sheet. And then we are saying, as a note, NB, that some organizations may not report subscriptions as income until it is received in cash. So depending on the policy of the organization, sometimes they may be adopting the cash basis of these subscriptions. So if they are deviating from the accrual principle, then you will then not have debtors for subscriptions, neither will you have creditors for subscriptions. But we are saying the general application is the accrual principle, unless the entity decides that it will treat these entities as unless the organization decides it will treat these entities as or they will treat these subscriptions based on cash. So having said, so that is how you treat subscriptions. So subscriptions are treated as incomes for that particular year. Any income in form of subscriptions not yet received, we call it debtors for subscriptions. Any income in form of subscriptions received in advance, we treat it as creditors for subscriptions, unless and otherwise the entity adopts the cash basis of accounting. Now, the next item is to look at income from investments. So sometimes these organizations may receive incomes from investments. So they may have investments that they have made. For instance, they could have invested in shares, they could have invested in fixed deposits accounts and etc. Or they could have invested in treasury bills or even any other investment. So we are saying then, if the investment has no specific intention, if the investment has no specific intention, then the income from such investments should be treated as income and therefore reported in the income and expenditure account. So if it is just a general investment, that is, they are not investing for a particular reason or for a particular purpose, then income from such an investment should be treated as the general income and therefore reported in the income and expenditure account. However, if the investment is made for a particular purpose, like for example, for building, that is, you have a building fund, then any income from such a fund is to be credited to that particular fund. So in this case, we look at the purpose of the investment. If it is a general investment, then income is treated as a normal income in the income and expenditure account. But if it is for a specific purpose, then you will find that that income should be, the income should be credited to the particular fund for that purpose. So that is the income from investment. So there are two ways to it. You can treat it as a general income if the investment is a general investment, or if it's a specific investment, the income is credited to the specific fund. Then number three, we have the life membership fund. The life membership fund. And we are saying that sometimes members may pay amounts to become life members of the organization. So there are those that income that is paid, or that money that is paid by members uh, to become life members. Then such monies are put in what we call the life membership fund. The life membership fund. So if this happens, that is, if some money has been paid for one to become a life member of the entity, there may be need to spread out this income over a number of years. So we normally say that over the expected life of the membership of the members in the club. So there could be different policies that are adopted by the organization. So we have a number of ways in which this money for the life membership can be treated. So the first way is to treat the money from the money received from the life membership fund be reported in the income and expenditure account in the year it is received, and therefore no balance is retained in the life membership account. So you may decide to report the entire amount in the income and expenditure account. So this money should be recognized as income in the income and expenditure account. So it means, therefore, if you decide to recognize it as income, then there will be no balance to be retained in this fund. Number two, you may decide to show this amount in a separate account, which we call the life membership fund, with no transfer. So there will be no transfer to the income and expenditure account. So you may decide that you treat this amount as a fund and have it a separate item as a life membership fund. So the life membership fund should be treated as a liability in the balance sheet. So you may decide that the entire amount be put in a separate account we call the life membership fund, meaning no transfer is made to the income statement. And number three, you can decide to transfer some of the amount to the life membership fund and some to the income expenditure account. So there are three ways. Number one, you treat it as income and therefore don't create a life membership fund. Number two, you treat it as a life membership fund and therefore you report it as an item in the balance sheet. Or number three, you create a life membership fund where you will be transferring some amounts to the income and expenditure account over the life or over the expected life of the organization. So in other words, we are saying you create a life membership fund and progressively, amortize the life membership fund over the life of the organization. So you create this and continually be able to amortize until the life of the club or the organization is over. So those are the three ways in which you can treat this money. So the life membership fund are monies received from the members who decide to become life members. So if they want to become life members, they pay for the life membership. So in this case, you have three ways in which you can treat the money received for life membership. You can decide to report it as income in the income and expenditure. Therefore, do not create a life membership fund. Number two, you can decide to create a life membership fund and therefore don't report it as income in the income and expenditure account. And number three, you can create a life membership fund and progressively amortize that amount until it is fully exhausted. Then the fourth item is on other funds, and we are talking about other funds like uh, uh, the education fund, the building fund, and etc. So we are saying that these other funds are those funds that are normally formed for specific purposes. So if they are formed for specific purposes, then you will treat them together with the accumulated fund. So if you have decided to set these funds, any income that you generate from these other funds, which are now in this case specific, you will credit those incomes to that specific fund. If there are expenses that are incurred for that specific fund, then they are also debited from that particular fund. If you have decided to put in place a building fund, then expenses of the building fund are deducted from the fund, while incomes from the education fund or the building fund should be credited to the building fund. Then we have other items like the entrance fees. So normally these fees are paid once. They are paid once. So if entrance fees are paid only once, then they will be treated as capital receipts. So if entrance fees are paid only once, then you treat them as capital receipt. And remember here, you will of course report it in the receipts and payments account, and of course as part of the accumulated fund. But if they are paid annually, then they are treated as income and therefore credited to the income and expenditure account. So it will depend on the frequency of these fees being received. So we are saying if it is a one-off kind of receipt, then it should be treated as capital and therefore treated together with the accumulated fund. But if they are paid annually, they are received every year, then you should report them as income and therefore it will be part of the incomes in the income and expenditure account. Sometimes there could be sale of newspapers or periodicals. So for organizations, normally they receive these periodicals, so they may decide to sell the old ones. So all the newspapers, magazines, periodicals are sometimes disposed of every year. So if that is the case, then the amount received from the sale of those old newspapers, magazines, and other periodicals, they should be treated as income in the income and expenditure account. So you report them as being income from the sale of those old uh, 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 newspapers and other periodicals. The other item is the sale of sports material. So some of the used sports materials may be sold. So any proceeds that you get from selling those old sporting materials should be reported as income in the income and expenditure account. Now, we have an item of honorarium. We have an item of honorarium. So sometimes the organization may invite uh, people to give lectures in the process of entertaining the members, or you can even invite an entertainment group to come and entertain the members. So any money is paid to such persons who come to entertain the members or even educate the members and etc. We call it honorarium, and any of such monies will be treated as an expenditure, and therefore it should be credited to the income and expenditure account. Sometime there could be a sale of an old asset. There could be a sale of an old asset. If that happens, then that sale of an old asset should be looked at in terms of the proceeds you receive from the old asset and the value of that asset at the time of the sale. So, in essence, we are saying since this is not an item that takes place every time, so it is not a recurring kind of transaction, then you must determine whether there is a profit on sale of the asset or a loss on sale of the asset. If it is a profit on sale of the old asset, then the profit should be treated as an income item in the income and expenditure account. And if it's a loss, then the loss should be treated as an expenditure in the income and expenditure account. So, how do you determine that you made income or you made a loss? So, you can either make a profit if the sale proceeds are more than the net book value, and if the net book value is more than the net than the sale proceeds, then difference should be a loss. So that is how you treat the sale of an old item. Then we said general donations are what we call incomes, but we have specific donations. So the specific donations are received for specific purposes. For instance, donation for a building, donation for prizes, donation for a pavilion, etc. So these are uh, uh, capital receipts, and therefore they cannot be shown as an item of the income and expenditure, and therefore they are shown as liabilities in the balance sheet. But for general donations, which are not for specific purposes, these ones are shown in the income and expenditure account as incomes. Then we have the endowment fund. The endowment fund. An endowment fund represents a donation for a specific purpose. So you'll find that the purpose of the donor is to provide a source of permanent income to the institution. Therefore, if this is received, that is a donation for a particular purpose, it should be shown as an item of liability in the balance sheet, and any income earned during the year from the fund, it should be added to the fund, and any expenditure incurred for the purpose of the fund, it should also be deducted from the fund. So for an endowment fund, you'll find that these are specific fund donation that is received, and the purpose is simply to produce income for the organization. And then we have other incomes like proceeds from concerts, lectures, and dramas or cultural shows. So any monies from this should be treated as income from income for the organization, and therefore reported in the income and expenditure account. So we have government grants, government grants. So we have two types of these grants. We have what we call the maintenance grants, and you'll find that the maintenance grants are for meeting recurring expenditures. So any maintenance grant that is received by the organization, it should be treated as income and therefore are reported in the income and expenditure account as income. However, for development grant, it is meant to acquire certain assets and therefore it should be recognized as a liability in the income, in the balance sheet. And of course, we have the accumulated fund, which is an equivalent of capital for a profit-making organization. So you'll realize, as I said earlier, that the non-profit-making organizations are not owned by specific owners, meaning they have no owners. So how are they then, how are those organizations then formed? They are formed by the what we call the accumulated fund. So we are saying all entities that are not profit making will also require money, similarly to the profit making organization. So we are saying whether they are profit making or non-profit making, they will require money to finance their activities. So in a business organization, we call such monies capital, but in a non-profit organization, we call it the capital fund or the accumulated fund. So that simply means that the accumulated fund will represent the surplus of assets over the outside liabilities. So we are simply saying the difference between the assets and the liabilities will give you the accumulated fund. And we are saying this fund will either be increased by a surplus or decreased by a deficit. So a deficit will increase this fund, will decrease this fund, and a surplus will increase this fund. To put into perspective what we have been looking at, let us look at an illustration whereby now we will be required to prepare the financial statements of a non-profit making organization. So we are told that the following is the receipts and payments account of the Denko Club for the year ended 31st December 2020. So the financial year ended on 31st December 2020, meaning it must have started on 1st of January 2020. So we have, this is what we call the income and expenditure account, the receipts and payments account. So we have the receipts and payments account. So we have the debit side, uh, which should be recording our receipts, and the credit side, which records the expenditures. And remember now, these are actual inflows of cash and outflows of cash. So the opening balance, which is that 1st December of 2019, that is the 102,000. So we have receipts of entrance fees of 42,000. So there were receipts of subscriptions which were meant for 2019 of 25,000. The receipts for 2020 which were received in 2020 3 or 5,000, the receipt 35,000. So these receipts of subscriptions of 2019 were received in 2020. So these ones were received for a previous year. So they must have been creditors for, the debtors for subscription, and these ones that are received for 2021 are creditors for subscription of 2021. So this amount was received in 2020. So 25,000, 305,000, and 35,000, all these were received in 2021. But we are saying the 2025, the 25,000 is meant for 2019, the 35,000 is meant for the next year, 2021. Then monies received from the sales from the bar. So we have the bar sales of 5,227,000, and then we have the sale of investments, which is 750,000. So these were the monies received. Then we have the expenses, monies paid out for expenses. So for the purchases of the bar, 4,434,000, the wages 416,000, the rent 186,000, heating and lighting 128,000, postage and stationery 33,000, insurance 18,000, general expenses 46,000, payments of furniture 450,000. Then we have the balance of 775 shillings in the bank. So that is the income and the receipts and payments. And then we are also told that we are also given the following information. We are also given the following information that number one, we have the balances. So we have the balances at the start of the year and at the end of the year. So at the start of the year, the stocks were 272,000, and at the end of the year, 315,000. So we have the creditors for purchases, the creditors for purchases, that is the current liabilities, that is the amounts that are not paid, the amounts that are paid in advance. So we have the 306,000 at the start, and at the end 358,000. Then we have the rent due 18,000 and 36,000 respectively. We have the heating and lighting expenses due 16,000 and 19,000. We have subscriptions due. So these are like debtors for subscriptions. So these are the creditors for bar purchases, and these are the creditors. The debtors for subscriptions, 25,000 and 40,000. Then we have the insurance paid in advance, 5,000 and 7,000. So that is information number one. Then information number two, we are told on 31st December 2019, that is at the start of the current year, the club held investments which cost 500,000. So the cost of these investments was 500,000. So during that year, the investments were sold for 750,000. They were sold for 750,000. So these investments that were held at 500,000 were sold for 750,000. So it means there has been an income, a profit for sale of these investments. The difference being 250. So it is 750,000 minus the 500,000. Then you are told that furniture was valued at 300,000 on the start of the year. And we are told on June 2020, in the middle of the current year, the club purchased additional furniture at a cost of 520. So the starting furniture was 300,000. Then there was an addition of 520,000 for which was done at the middle of the year. Then depreciation of all the furniture to be provided at the rate of 10% per annum. 10% per annum. So this 10% per annum will only apply the entirely for the furniture of 300,000. So we are saying then that the depreciation for furniture should be computed in twofold. The first 10% of 300,000, which is 30,000. So we have the depreciation for this part of the furniture that cost 300,000. So, and it is 30,000. But for this 520, it should be done at 10%, yes, but only half the year because the purchase was on June 2020. So in this case, it is 10% of 520, which we get 52,000. And when you multiply by half, because the furniture was used for half of the year, then you should get 26. So it should be 26,000 plus 30,000 to give you 56,000. So the depreciation should be at 56,000. So we are required to prepare an income and expenditure account for the year ending December 2020 and a balance sheet as at that date. So the first thing you normally should do is to determine the accumulated fund, which is an equivalent of capital. So what you are supposed to do is to look at the assets at the start of the year and less the liabilities at the start of the year. So the first thing you do is to determine the accumulated fund, because in this our illustration we have not been given the accumulated fund, and this is an equivalent of the capital. So we have to look at the uh, uh, assets that were there at the start of the year and the liabilities at the start of the year. So the first thing that we are supposed to do is to look at our uh, the receipts and payments account. So the opening balance in the receipts and payments account is 102,000. So whatever we have in the bank is 102,000. So when we have to look at our solution, when we look at the solution to this illustration, we first look at the accumulated fund, as I said. So the first thing we should be able to, of course, show is our stocks. And you can see for our stocks here is 272,000. That is the opening stocks, because we are determining the accumulated fund at the start of the year. So for the stocks is 272,000. And then we have the debtors for subscriptions. Debtors for subscriptions due here. The debtors for subscription, 25,000. So we have our debtors here, 25,000. We also have insurance that is prepaid. We have insurance that is prepaid. You can see prepaid insurance paid in advance, 5,000. So we have our insurance prepaid in advance, 5,000 here. Then we were told at the start of the year, we had investments of 500,000. So these investments at the start of the year, you can see the debt is 500,000. So that is why we have this item of 500,000. We had the furniture at the start of the year. We had the 300,000 here on our additional information number 3, the 300,000. So at the start of the year, you can see the debt. The debt is 300,000. So that is why we have the 300,000. And then the amount in the bank, which we find in the receipts and payments account, 102,000. So that is what we have here, 102,000. 102,000 here. So these are the assets. So the total assets at the start of the year is 1.204 million. And then, of course, we less the liabilities. You can look at our liabilities here. We have the creditors for bar purchases, 306,000. That is why we have this item of 306,000. We have the rent due. You can see from our illustration here, we have the rent due at the start of the year, 18,000. So when we look at our item here is 18,000, and we have this accrued expenditures of heating and lighting, 16,000. So you can see we have it here, 16,000. So when you total all this, you get 340,000. So when you deduct liabilities from assets, you get 864,000. So this is an equivalent of capital, which we call the accumulated fund. So we have found the accumulated fund of 864,000. Now, given the fact that we have been told that we have a trading segment of this club, we have a bar. So the bar becomes the trading part of this organization. So we may need to determine the profit from the bar. We have to determine the bar profit. So in that case, then we have to prepare a trading account. We have to prepare a trading account. But before we prepare the trading account, we have to realize that we have two items that may require adjustment. The first one are the creditors. We have the creditors. So we have to maintain the creditors control account. And the purposes of the creditors control account is to determine the total amount of purchases that were done, the total amount of purchases that were done. And then we have this item of subscriptions. We have the item of subscriptions. Since we have subscriptions for 2019, 2020, and 2021, we have to determine the actual amount of subscriptions that belong to 2020. So we prepare the creditors account to determine the actual purchases and the subscriptions account to determine the subscriptions for 2020. Now, let us start with the creditors, and we use the creditors control account. Now, we have the opening balance of the creditors. So from our illustration here, so the creditors, we have the 306 as opening and the 358 as closing. So since the creditors are liabilities, the balances are credit balances. So the balance brought down is 306, as you can see. And of course, the closing here is 358. And then we look at the cash purchases. The cash purchases. So the cash purchases, as you can see from the receipts and payments, is the 34,34,000. So this amount is for the cash purchases. So when we record this, we debit this account with cash purchases. Then we balance off the account. So the balancing figure is 4486, which should be now the actual purchases for 2020. So the actual purchases for 2020 is the 4486. Therefore, this is the figure that we will use for purchases. And then when it comes to subscriptions, we have to have the balances brought down and the balances carried down. So we have the balance from 2019, which is 25,000. Then, of course, we have the monies received the monies received from that for 2020. So for 2020, that was received. So here we have the subscriptions. So 2020, the 25,000 is for 2019, which is the balance that we must have brought down. And then the amount received for 2020 is 305. And the amount for 2021, which should be the closing balance, 35,000. So if we were to place those amounts here in our account, so we have the 25,000, which was for 2020. So we have 25,000, and then uh, uh, we look at the balance which for 2021, which is 35,000. Then we look at our receipts. We look at our receipts in the income and expenditure and the receipts and payments. So in the receipts and payments, sorry, let us look at the ones in the income, the receipts and payments. You can see from our receipts and payments, we have 305,000. We have the receipts of 305,000, but we have to determine the receipts for the current year, the receipts for the current year. So the receipts for the current year are 305,000. The receipts for the current year are 305,000. So this should be added to the receipts of the next year, 2021. Let us look at our subscriptions account. So the receipts of the particular year is 365,000. So we want to find out how much should we charge in the income and expenditure account as being the amount of subscriptions for that particular year. So it will be 365,000. We add the 40,000, and of course we get 405,000. So when we balance this account, we should get 355,000, which will be the amount we take to our income and expenditure account. So the amount received in the receipts and expenditure account is the 365,000. So the 345,000 should be taken to the income and expenditure account. So having gotten those two items, the ones that we are supposed to take to this, we prepare the trading part of the organization. And of course, we know the sales is 5.227 million. And of course, you get this figure from the receipts and payments account, where we have the bar sales of 5.227 million. And then, of course, from that, you have to deduct the cost of sales, and of course, the cost of sales, you consider the opening stock, 272,000. You can see from our additional information, the opening stock is 272,000, and the closing is 315. So at this point, so we have the 272,000 as the opening stock. For the purchases, we found this figure from our creditors account, 4486. So we bring it here, 4486. So when we total 272 plus 4486, the goods available for sale will be 4758,000. Then we less the closing stock, we have found to be 315,000. So 315,000 here, 315,000. So the cost of sales is 43,000. When you less that, you get 784,000. So the 784,000 will then form the profit from trading activities. Profit from trading activities in the income and expenditure let's proceed from where we were before the disconnection. So we had said that after we prepare the trading part of the business, then the next thing is for us to prepare income expenditure account. And of course, one of the items that are the income and expenditure account is the profit from the trading part, and we had computed that profit to be 784,000. So we bring that item to the income and expenditure account as one of the income items of profit from trading activities as 704,000. And if you look at our income, there is an expenditure account, we have the amounts received from entrance. So we have the entrance fees of 42,000. We have the entrance fees of 42,000, and that item you can see it is in our income and expenditure as entrance fees of 42,000, and subscriptions found this amount from our subscriptions account 345,000, and then said from the sale of the investments of 250,000. That is, we saw investments for 150,000, but the value of investments at the time of the sale was 500,000. So there was a profit of 250,000. So total of these incomes comes to 121. Then we have the so we have wages, we have the rent, we have the heating and lighting. So wages is 416,000, the rent is 204,000, heating and lighting and 1,000. And then we have the postage and stationery 33, the insurance 16,000, and excess 6. Depreciation we computed with the depreciation that runs for the entire year was 300,000. 20% 300,000, we get 30,000. Then we add the additional furniture depreciation, so 520,000 multiplied by 10% to give you 50,000. But since this part of the furniture really existed for 6 months, so we multiply by half and we get 26,000. So 26,000 plus 30,000 should give you 56,000, a total of 902,000. So there is a supply of 519,000. So this is the surplus that will then increase our accumulated fund. Remember, our accumulated fund, we found it by assets at the start of the year against liabilities at the start of the year, and we found then the related fund 864,000. So that will then be able to increase that 864,000 by 519. So we are supposed to prepare the balance sheet. We said the part of the balance sheet, we have no difference between that of a profit making and non-profit making. So you'll find that we have the furniture whose total cost is 820,000. The total the 10,000, the additional of 520 to give you 820,000, and we have computed the accumulated depreciation of 56,000. So the book value is 764,000. So we then add the current assets of the stock, which is 300,000. We have the subscriptions at 40,000 of the prepaid expenses, 7,000, and of course the cash at bank. Now processing balance at the receipts and payments of 705,000 to give us a total of 1.137 million. Then we have the current liabilities. We have the creditor 328,000. We have the prepaid subscriptions of 35,000, the accrued balances of 55,000, and the creditors of 70,000, so a total of 518,000. Have the difference between the 11,700 and 518,000 should be our net assets of 609,000. When you total the net current assets plus the non-current assets, net asset of 1383,000. Then, of course, we had the accumulated fund being found at 864,000 and the surplus 519,000, which should give 1383,000. So this is just but part of the many illustrations for this non-profit making organization. From the right, you will find several other examples, several other illustrations, and their suggested solution. So in this class, then we've been able to look at the accounts of non-profit making organizations, where we were able to look at the nature of organizations and the differences between these organizations and the profit making organizations. After, we were able to also the accounts that are prepared by these organizations, and we are able to see the two accounts, the three accounts: the balance sheet, the income and expenditure account, and the receipts and payments account, and of course an illustration to show how this is prepared. So that brings us to the end of our class, and have a good time.